Well, hello and welcome to this session of ExecuNet Masterclass. I'm your host, as always, Tony Vlahos, and my guests today are the principals of an organization called Acquisition Finders, and they are Misters Patrick Barton and Austin Adams. So if you're considering your next great career move, as many top executives are these days, you will be really glad you tuned in today because today our session leaders will be telling you pretty much all you need to know about the exciting possibility of buying and owning an existing business. Really timely and important stuff, and part of our daily commitment here at ExecuNet to connect you with trusted voices, people like our friends from Acquisition Finders, who will expertly guide your next big step so you can successfully take your career forward. Well, I am delighted to introduce my guests today, and I will tell you briefly about each of them. Pat Adams is the managing partner and owner of Acquisition Finders. Prior to joining Acquisition Finders, Pat served as senior executive of multiple private and public companies, both domestic and international. He first came to Acquisition Finders as a client in search of a small business to buy. So suffice it to say, he's been in your shoes and is absolutely the right person to listen to and ask questions of today. We also have with us Barton Adams. Prior to joining Acquisition Finders, he led 3 sales teams in Denver across storage, networking, and video conferencing categories in the IT space. His teams were responsible for driving over $30 million in contract revenue annually. He's managed numerous teams, including his own book of business, and so he's got a deep understanding of what it takes to successfully operate your own business. Finally, we have with us Austin Adams. Now, Austin came to Acquisition Finders in 2018 after a decade in New York, where he was the national sales and operations manager for a multi-million-dollar luxury goods distributor, serving some preeminent department stores like Bergdorf Goodman, Barney's, and Saks Fifth Avenue. In his 4 years with Acquisition Finders, he has helped entrepreneurial former executives from wide-ranging backgrounds buy businesses in a variety of industries. So with those brief introductions, gentlemen, welcome to the ExecuNet stage. They are all yours.
Thank you, Tony. Good morning or afternoon, or maybe even good evening, depending on where you are watching this from today or when you're watching it. My name is Tony said, is Pat Adams. I'm the managing director and owner of Acquisition Finders. And as Tony shared, I was originally introduced to the company as a client after stepping down as CEO of an international manufacturing business owned by private equity. Today, we'll be sharing some of the key issues and considerations in acquiring a business, not just as an income replacement, but a real company that you manage and grow as you see fit. We assume since you are attending or will be listening to a replay of this webinar, you're at least contemplating the next step in your career. We also expect that as an ExecuNet member, you've achieved a solid success in your career and that considering business ownership should be an option that you at least carefully evaluate. Through my career, I've become convinced that the best way to generate some personal wealth and a superior quality life is through business ownership. Acquisition Finders' primary service is conducting custom acquisition searches for individuals and companies looking to expand. We also work with private equity and family offices, but normally not on a custom search basis. I'm sorry, we're having a little click issue. Today, Barton and Austin are joining me in the presentation. And yes, they're both my sons. They've been with us for over 5 years. The company is based in Nashville, but we have principals also in Memphis and Atlanta. And we've been providing acquisition services nationwide for about 12 years. Our goal is to provide essential information that will help you decide if you should give strong consideration to buying and managing a business. Austin will share information on why you should consider ownership, share some thoughts on finding the right business for you. Barton will discuss acquisition search options, the key process steps in buying a business, and how to value a business. I'll finish with some information on how to pay for the business and a few closing comments. We intend to leave plenty of time for questions, and of course, you can contact us to provide more details and discuss your individual situations. Our goal is to help you determine if ownership might be a good career option for you. So I hand it to Austin to begin our presentation.
Hi, everyone. I'm Austin Adams. Happy to be with you today. Everyone attending this presentation has thought about buying an existing business. And you've probably also all thought about starting your own business or taking another job in the corporate world. So the first question I want to consider is, why should anyone generally buy an existing business? We'll start by talking about the differences between founding your own business and buying an existing one. And I'm sure you've all read the statistics. According to the SBA, about 20% of new businesses fail within the first year. Almost half fail within the first 5 years. Why? Every failed business has its own story, but there are a few key reasons why new businesses fail at such a high rate. First, there's no immediate cash flow. Everyone on this call has become accustomed to making a certain income. You can't make any income from a new business until you firmly established it. That on average takes between 18 and 24 months. Compare that to buying an existing business where there's cash flow from day one. You're in control of what business you buy if you're buying an existing business. That's an important fact to keep in mind throughout this talk. So if there's a certain income level you require, let's say you need $400,000 a year, then you'll focus on finding a business that provides you with $400,000 a year. If you're working with an experienced intermediary, they can tailor their outreach to the businesses that are most likely to provide you that level of income. They can filter out the ones that are either too small or too large. When you buy an existing business, you're taking the salary you need from day one because the business has cash flow. In a startup business, in addition to not having cash flow to pay yourself, there's no immediate money to run the business. How do you pay vendors? How do you build inventory? How do you buy equipment? Those are huge challenges in a startup business. But when you buy an existing business, you're buying a fully functional, healthy company with a track record of success. So remember, you're in control of what you buy, and you're not going to buy a lemon. Before you close on a business, you and your intermediary are going to gather financial information from the business and perform an in-depth review. You'll know exactly how much money the company's been making over the last few years. You know what they've been spending their money on. You'll have a pretty good overview of what the business looks like. And then if you put in an offer on the business and it's accepted, you and your CPA will engage in an exhaustive due diligence process. By the end of that, you'll know the business inside and out. And if you discover any red flags during that process, you just won't buy the business. So what about the cost? Isn't it expensive to buy an existing business? You do need to have equity money, but the bulk of the purchase price of the business will be financed, and you'll pay down the loan with profits from the business, that the business is generating. A healthy business pays for itself. For most small business acquisitions, buyers are best off securing their financing through the SBA. The SBA interest rates are still historically low, and financing is very active. So, it's clear that buying an existing business can be an attractive option for some people, but is it the right option for you specifically? A couple of key questions to consider. Are you entrepreneurial? Are you satisfied with your current work situation? Do you actually want to be your own boss? Ask yourself questions like, how often have you felt underappreciated at your job? How often have you taken on existing or additional responsibilities without any additional pay? Those are almost rhetorical questions because I think everybody deals with that. Every employee deals with that. But by and large, bosses don't. When you're the one in control, you can reward your own hard work. But the flip side to that is when you're the boss, the buck stops with you. Owning a company does give you greater freedom, but it also demands greater responsibility. Do you want that? Is that a work-life balance that works for you? It's an important consideration. And then you need to account for how much free capital you have. Do you have right now enough money to buy the sort of business you want? Later on, we'll talk about how much money you need to structure an attractive deal. So who's buying and who's selling these days? The typical buyer is someone with executive experience. It's someone in their 40s or 50s on average, someone who's eager for a new challenge or tired of where they are. It's someone who wants to be in the captain's seat. The typical seller is someone who's run their business for at least 15 years. Most of acquisition finders clients are looking for a business where they can personally make somewhere between 300,000 to 2 million in a year. That's not set in stone, but typically those are the sort of businesses that our buyers are targeting. Most sellers are ready to retire, or else they're looking for a new challenge. Business owner can also get tired of what they're doing and want to change industries or just, try something new. And then we also find most sellers are people who've become complacent with the size of their business. They're doing better than they ever imagined they would when they first started out. So they're not trying to aggressively grow the business, even if there are opportunities that are right in front of them. Someone like you can come in, you can take over, and you can capitalize on those existing opportunities. So why buy now? 79% of business owners don't have an exit strategy. They're not planning to pass their business on to a child. They're not planning to sell it to an employee. They aren't currently working with a broker to sell their business. When an owner's ready to sell, most of the time, they don't know how to sell it or who they should sell it to. That's where working with an experienced intermediary becomes essential. At our firm, we specifically focus on contacting businesses that aren't being actively marketed for sale. And what we're trying to do is find those owners who are ready to sell, but they don't know how and they don't know who to sell to. And I mean, look, if it's the right business for you to run, then you're the right owner for the business. You just have to be connected with the right seller. And then 60% of US businesses are owned by baby boomers. Most baby boomers plan to retire within the next 10 years. What that means for you is there are a lot of owners looking to sell now, even if they don't know how to go to market. And then COVID. COVID created opportunities as much as it created challenges. The last 2 years have been unusual, to say the least. COVID hurt a lot of businesses, helped a lot of businesses. Brick and mortar retail got hit hard, but direct to consumer online sales did phenomenally well. Ultimately, COVID's just another factor to consider when looking at a business's financials. If you find a business you love and they were hurt by COVID, you and your intermediary will study their balance sheets and P&Ls, and you'll be looking to see how well and how quickly they're recovering. And on the flip side, if you find a business that saw a big boost because of COVID, you have to ask yourself whether the boost was short-lived or whether it's sustainable. And your answer to that question is going to influence how much you should pay for the business. What it really comes down to is the right time to buy is whatever the right time is for you. No matter what industry you're interested in, what geography you're in, there are always attractive businesses to sell, looking to sell. You're the biggest variable. Do you have time to dedicate to a search right now? You're going to need to be able to dedicate at least a few hours a week to it. If you're working with an intermediary, every time they uncover a business that's well suited to you, they're going to introduce you to the owner. And you're going to need to be free to meet with that owner within a week or 2 weeks of the introduction being made. Another question is, do you have the equity money you need now? If you don't have enough now to buy the size of business you want, it's probably best to keep saving until you do. And then another consideration is, look, buying a business is exciting. The whole process is fun. It's an adventure. It's something you should enjoy, but it's not stress-free. Are you emotionally and psychologically ready to take on that challenge right now? And if you are, then you're probably wondering, what kind of business should I buy? When we onboard a new client, we spend a few weeks with them, profiling their professional history, their skill sets, their personal interests. And during that process, they usually ask a question like, which industries are hot right now? That's an understandable question to ask. You want to make sure that you're getting into a business that's attractive and that's going to continue to be successful, but it's not quite the right question. The kinds of industries we focus on and the industries we advise our clients to focus on are tried and true. It's B2B services, distribution, manufacturing, personal services. You don't want to bandwagon into a fad business. You don't want what's hot right now. You want a business that's healthy now, that was healthy 10 years ago, and that's going to be healthy in another 10 years. And sure, there are macroeconomic trends you should pay attention to when you're deciding what business to buy. I mean, every time I talk with an owner, I'm looking to see whether or not they could potentially face competition from Amazon or Google or some other large internet corporation. But ultimately, the factors we've been discussing are the factors that matter most when it comes to finding the right business. How much do you need to earn? What are you interested in? Are there industries that seem especially attractive to you? If there are, your intermediary is going to be, sure to include them in your search. What kind of executive experience do you have? What sort of support system are you going to need in a business? If, say, you've never run sales before, you might want to look for a business that has a strong sales manager in place. Equally important is being open to new and unexpected industries. What you're looking for is a healthy business making the right amount of money where the role that the current owner plays is one that fits your skill sets. Maybe that's a business in an industry you've worked your whole career in. Maybe it's an industry that you've never considered working in before. So let me give you an example. In 2018, I was working with a client whose entire career had been spent in semiconductor procurement. It's a very niche industry. The business she wound up buying, the one that wound up really being perfect for, was a company that managed janitorial services for model homes. It wasn't an industry she had ever considered, but after we reviewed the financials, met with the owner, turned out it was the right fit. What you're looking for isn't simply a familiar business, it's the right business. That means a business that's stable, that has longevity, that's making the right amount of money for you, where you can step into the owner's role, potentially expand that role. You're looking for a business in an industry you can understand, regardless of whether or not it's the industry you come out of, and you're looking for a business that you can afford. So how do you find that business? Barton will take us through that process.
Hey, everybody. I'm Barton Adams. Like Austin said, I'm going to walk you through the search process. I'm going to discuss how we find quality, the highest quality businesses during a search, and how you determine what a business is worth. Let's start kind of with the search process. So there's a number of ways you can take on a search for the right business. One of those is you can go it alone. Maybe you know of a few businesses you'd be interested in purchasing. You can reach out to the owners and see if they'd be open or willing to sell. If they are, you're going to be handling negotiating and pricing on your own without the benefit of any industry specific information. You're going to need an attorney to help you with a letter of intent and a purchase agreement. Plus, you'll need to hire an accountant or a CPA to analyze all the financials for you, especially if you're not adept at reading income statements and balance sheets. Another option, you contact a local business broker. This option is going to give you a list of businesses in your area that are for sale. Brokers work with all kinds of businesses, from those that are highly successful to those that have owners that are really just looking to get out. So, according to the Exit Planning Institute of Ohio, only 20 to 30% of listed businesses actually sell. So your options for finding a good business are going to be limited. Plus, you're still going to need all the assistance from accountants and attorneys that you'll need if you'd gone it alone. A broker is going to present you with businesses they and their firm have listed for sale, and this potentially limits your pool of businesses from which to choose from. Another option, you can search online. There are several online repositories with businesses for sale across the country. This is going to give you more options to consider than contacting a local broker directly. However, these sites are really just extensions of brokers. It's where they post their businesses for sale. So while you're going to have more options, the percentages are still against you, and you still have to hire all that outside help. The other option is using an intermediary. Working with a buy-side intermediary, such as acquisition finders, the first difference you're going to notice is all the customization that goes into your search. We're going to work with you to understand your background, your financial requirements. Then we're going to use that information to build a profile for your target business. We'll build a customized list of hundreds of businesses in your target area to reach out to across a wide array of industries, and then perform that outreach for you. We use multiple methods to reach business owners, encourage them to engage with us in a discussion. We have the conversations, we get all the necessary information for you so that you can initially review a business and determine, your level of interest in that business. From there, we collect financials and put together the initial analysis, which is going to save you on accountant or CPA costs. And then we use industry specific information to put together a valuation range and determine a price and craft an offer for you. We also write your LOI, so you're not going to incur unnecessary attorney fees on that part. Ultimately, once you've found the right business and we've signed an LOI, you will need an attorney to put your purchase agreement together, and you will want an accountant or CPA to do that deeper dive into the business's financial, like Austin mentioned earlier. But what you receive working with an intermediary like Acquisition Finders is a list of businesses across numerous industries, ones that primarily are not on the market today. You're going to be armed with all the information you need to make an informed decision. You're going to have a partner working with you throughout the entire process. Simply put, your business acquisition search will be more successful working with an intermediary. So I mentioned that an intermediary service can make your search process more successful. Each intermediary firm has a different approach. So just for ease of explanation, I'll speak to our process. So why do our clients choose to work with us? It's fairly simple. We find our clients better businesses. Our firm's driving force is buy-side acquisitions for executives like yourselves. We spent over a decade crafting our program. We have the infrastructure and staff in place to handle significant outbound marketing for all of our clients, allowing us to truly target hundreds of businesses for each client. On average, we reach out to 700 to 900 businesses for each client, which is a daunting task for anyone to take on. We take the grunt work out of the search process for our clients. We filter opportunities for our clients so they only consider businesses that meet the criteria we set with them at the onset of our engagement. And also, we mentor our clients throughout the process. We act as a sounding board for our clients, and we're in a position to do so because we've engaged with tens of thousands of businesses across the country, across all different types of industries, and our clients simply haven't. We're consultants in this process. And finding a better business means that you need to consider as many businesses as possible. Otherwise, how do you know you found the right one? There are more off-market opportunities in this size range this audience is looking for than on-market opportunities. It's just a simple fact. Acquisition Finders, because of the engagements we've had on behalf of our previous clients, we've got relationships with business owners across the country who want to sell, but they don't want to be listed publicly. In fact, we've got a program that specifically targets this market. We call it our Hidden Gem Marketplace. We have a number of search programs available for our clients, giving them options in how they approach their acquisition search. Finally, finding a better business requires knowledge about a variety of industries. Every industry has specific items that need to be taken into consideration when determining a price, but you also need to know the right questions to ask an owner so you get the total picture of their business. We've been doing this for over a decade. We've got the experience buyers need when they've decided they want to buy a business. So, what's the process of buying business look like? Well, working with us, the process of buying a business is streamlined for you. We're going to help you from start to finish, from determining the right size of business and financial needs you'll have to take home the salary you need, while allowing the business to pay for your debt service on its own, to helping collect all the necessary financials and paperwork your attorney and CPA will need during due diligence. We carry you through the process. One of the questions we're asked the most is, how long does this process take? I'd love to give you all a finite answer, but the truth is no two searches are the same. Maybe we know of a business owner that wants to sell and it's the perfect fit for you. In that case, things could come together as quickly as 4 months. In other cases, it may take multiple rounds of outreach, and in some cases, even the development of a secondary list of targets before we're able to find that right business for you. In those cases, you could be looking at 9, 12 months, potentially longer. The point is, the right candidate for our process and this type of process is someone who's invested in finding the right business, not just a business. Patience is a virtue. It's never been truer than in a buy-side acquisition search. Now let's talk a little bit about knowing what a business is worth. So how do you know how much to offer for a business that you found? What do you need to consider when determining value? Well, one thing you've got to know is that your lender is going to order a third-party valuation on the business. They're going to look at the value you've placed on cash flow, and businesses that are heavily asset-based, they're going to look at the value you placed on that as well. That could be anything from machinery, equipment to land. But they're going to order that third-party, non-biased valuation to make sure the price that you've put together and offered and agreed to is in line with what the third party would agree with as well. So on this slide, you can see that there are multiple methods for determining a valuation range of a business. Every industry has specific items they want taken into consideration when a buyer makes an offer. Also, every buyer wants to know how you got to the price you've offered them. When our firm extends an offer, we do so in a presentation format. We clearly lay out the financials we've used to establish that owner's cash flow and the method we've used to determine our valuation. You never want to present a price to a seller without explaining how you came up with it to them. It can come off as lazy and it can turn them off from considering you as a buyer. So with so many methods out there, is there an industry standard? SDE plus market multiples valuation is, generally speaking, the most widely accepted valuation method today. Also referred to as multiple of discretionary earnings. This method first determines the SDE, which is seller's discretionary earnings. It really just means the total salary plus personal benefits they're taking from the company today. Next, the method is going to take an industry-specific multiplier, and it's going to apply it to that SDE, which then prices the business against its counterparts in the market. How do you know what multiplier to use when using this method? Well, first, you need to take the historical financial information of the business into consideration. Then you need to be knowledgeable about that business's industry. There are multiplier ranges for each industry, and determining where the business falls within that range is done all based on the financial position the business has been in the past few years. This method is trusted by lenders and typically is the method a third-party evaluator is going to use. It provides a simple, clear explanation of value to the seller and shows that you've considered every aspect of their business, plus you've educated yourself about their industry. Your intermediary needs to have this industry-specific information in order to put together an accurate valuation. Acquisition Finders does. Now with that, I'm going to pass it on to Pat. He's going to spend some time discussing how an individual actually buys the business they found.
Thank you, Barton. Basically, how do you pay for the business that you found? There are three primary components to funding most acquisitions. Equity is obviously the first one. It's the personal capital you have to invest to buy the business. Most transactions are going to require you to invest at least 15% and normally closer to 20% of the total purchase price. Your equity funds cannot be borrowed, but you can use a second mortgage or a HELOC, and co-investors are also an option. You can also use most retirement funds like an IRA or a 401k, but I do mention that Roth accounts do not qualify for this funding source. This does not require you withdrawing your retirement funds, so you avoid the early withdrawal penalty, and it negates the requirement to pay taxes on those retirement funds at this point. The process is done through setting up a ROBS account, which is a rollover for business startup. There are very specific rules to set up a ROBS account, but it's commonly used as a funding source. Seller note is second. This is simply the seller accepting partial payment over a period of time. Most sellers do not want to take a note, but lenders like it as it implies that the seller has faith in your ability to run the business. And it probably encourages the seller to be more positive and supportive post-close. Seller notes are normally for 2% to 10% of the purchase price. And these notes normally span 3 to 5 years. You pay interest rate at the market rates, which today would be approximately 5 to 6%. Financing, as Austin mentioned, is your primary source of buying the business. It's usually sourced through a traditional bank, but there are also non-bank lenders that are available. SBA guarantee programs, as Austin's also said, are the most commonly utilized funding source for personal business acquisitions. Conventional loans may be an option depending on the business assets and your personal net worth. Of course, you can borrow from friends and family, but we could all probably share multiple horror stories from people that we know that have done this. So we suggest you view this as the option of financing source of last resort. SBA does not supply the funds, but provides a lender a guarantee of 50 to 75% of the loan, depending on the program. SBA charges a loan guarantee fee of approximately 3% of the loan amount. These fees are what funds the SBA operations. Most lenders are qualified as SBA preferred lenders. This allows them to self-approve the loan, so all the SBA has to do is issue an approval number. Loans with non-preferred lenders go through the direct SBA review, and processing usually takes much longer. A preferred lender can approve most loans in 45 to 60 days, but we've got to share responsiveness to document request is a major variable in the time required to complete the process. These are documents from both you and the seller. PPP, EDIL loans, and COVID concerns have slowed the approval process since March 20, and COVID impact continues to create additional lender scrutiny, excuse me. SBA loans can go up to 10 years for a business acquisition and up to 25 years for property and or equipment purchases. SBA limits the maximum collateral to the amount of the loan, but since SBA's primary mandate is job preservation, this funding was established for financing acquisitions where the business and the buyer do not have sufficient collateral to justify a conventional loan. The SBA guaranteed loan is partially based on the business's cash flow, but we got to note that too much goodwill will cause most lenders to decline financing. The limit for an SBA guaranteed loan is $5 million, and SBA requires a personal guarantee on what you borrow. The interest rate and term is determined by the lender that you're working with. Some will offer fixed rates, but most want a variable rate, which allows them to sell that loan in the secondary market. Conventional lenders will normally insist on collateralizing everything you and the business own. Conventional loans normally require a minimum 20 to 25% equity, and lenders may or may not allow the use of retirement funds. When they do collateralize the business, they'll take everything you have, even if it puts them in a third position on that asset, because they want every possible opportunity to collect if you default, since that lender will now have 100% of the risk of a loan. Conventional lending usually requires more paperwork and time, but they do not incur a guarantee fee like the SBA does. These loans almost always carry variable interest rates and the loan term of 5 to 10 years. It may have a longer amortization period, which results in a balloon payment or a need to refinance the loan at the end of the loan period, but this helps you with cash flow during those initial years of the loan. Also, conventional loans do not have a specific borrowing limit, so the loan amount is dependent on the available collateral, the business cash flow, and most likely your personal net worth. For loans above $5 million, we commonly use a combination of an SBA guaranteed loan and a conventional loan, but we note that many lenders don't offer these combination loans. Financing can be very frustrating, but it's interpersonal relationships between the buyer and seller that often create the most difficult problems. And these are why the majority of deals feel like they're about to die at least once during the process, and resuscitation is required to save them. Normally, this is the first time either side of the transaction has done an acquisition, so there's a sizable learning curve. There are a lot of reasons both sides can become frustrated, so success requires continuous discussion, explanations, and often mediation, which a good intermediary should be able to provide. Understanding what's expected, the details of the process, and being prepared can mitigate most of the challenges as you go through due diligence, financing, closing, and the ownership transition. But there will be a diverse set of expectations from both parties, and the seller may not understand why the process has to be so complicated. Can't you see we are making good money and get on with it is a very common seller question. Having an experienced team will allow you to efficiently address financing, diligence, agreement drafting, and will save you money and time once the LOI is in place. An accountant with small business acquisition experience is mandatory. You need a qualified independent review of the financial aspects of the business to confirm what the seller has provided is accurate and that there are no hidden financial issues that might negatively impact the business post-close. And ideally, this will prepare your accountant to be a valuable supplier for you for routine accounting work going forward. An attorney with lower middle market acquisition experience is very valuable. There are excellent attorneys in smaller firms that are affordable and provide senior level support. While most agreements do start with a template, your attorney will draft the details of the purchase agreement, the non-competition, the non-solicitation, and the transition assistance agreements. Plus, if there's a seller note, they will also draft that. May also need to review certain contracts and licenses that the business holds, and that is going to be specific to the business you buy. And last, having a mentor, advisor, or intermediary that can counsel you through the process, can help you evaluate issues uncovered in diligence, provide experience in resolving disagreements or misunderstandings with the seller, and can make the difference in successfully closing on a good business, losing the opportunity, or worse, failing to address issues that may render this business not as good a fit for you as you had anticipated. Some of these comments may sound negative or even cause you to wonder if this is really worth the effort. But the truth is, if you're prepared, this will be exciting, fun, and allow you to avoid most of the frustrations because you know the challenges that will arise and that they can be addressed, allowing you to begin a great new adventure where you control your destiny. A few closing thoughts. Owning a business is not right for everyone, but it may be a great option for you. The only way to know is to seek experienced counsel that can help you and your family self-evaluate and gauge the risk and rewards. If you've had success, if you have confidence in your skills, and know how to listen and learn as you take on a new challenge, you will probably be a great owner. There are thousands of owners that have built businesses, but they do not have your experience, your skills, or your drive to fully leverage what they've created. They may have made more money than they ever expected, and they're frequently satisfied with status quo, which may provide a terrific opportunity for you. While service businesses should always be considered, there are manufacturing, distribution, and other businesses in almost every industry that may be a great fit for you. Just expand your paradigm regarding the specifics of an industry. As Austin shared, you want a healthy business that you can continue to grow and enjoy. And last, there are no perfect businesses, but there are thousands of really good businesses that can be acquired on reasonable terms. You just have to find a few of them, do the work to be confident that you can successfully, you can be successful in one of them after you buy it. If you have any interest or curiosity about business acquisition, please feel free to contact us. There's no pressure, there's no obligation. We genuinely want to help you make the decision that's best for you and your family. As Barton shared, we conduct an acquisition search that's customized to your skills, interest, and geography, but it does not have to be an industry or role where you've spent time. So being stuck in your current career role can be taken off the table. We search for off-market opportunities, and fortunately, there are many more of these than listed businesses. This provides our clients a non-auction opportunity to evaluate multiple businesses and hopefully acquire one. I will note we require our clients to have at least $300,000 of available equity to invest in the business, but we're happy to discuss the full process and your interest, even if you don't have that amount of money at the moment. There are alternatives that have lower capital thresholds, and we're glad to walk you through other options. Thank you for your time today, and now we'll turn it back to Tony for questions.
All right, terrific. Thank you, Pat and Barton and Austin. And as always, we have questions, and thank you. It was a comprehensive overview with such a great level of detail. But again, people are going to be prompted to think of some things we didn't address. For example, the audience would love to know, what is your engagement model? We understand that this conversation clearly is no obligation. You're not being paid to talk to people. This is part of what we offer to the ExecuNet community. But the question does come up, well, ultimately, who pays acquisition finders and how are you paid and upon which event?
Good question, Tony. And this is Pat. As we've alluded to, we are primarily buy-side representatives. So you as the buyer engage us in an agreement. Our agreement lays out the expectations you have for the business, but essentially we take a small initial retainer, and it's very small, and candidly, it's just to kind of weed out those people that aren't serious about an acquisition. If you're not willing to pay a couple of $1,000, $2,500 is our hurdle fee, then you're probably not serious about going after this process. It's a non-exclusive engagement. You may find something else. You may take another job with another corporate level position while we go through this, but then our compensation is based on a success fee. We use a modified Lehman schedule that is based on the purchase price of the business, and we get paid after you close on that business. So you pay us. We will do our best to help you in financing, to have sources that can help do that, but essentially you owe us. I will share that our fees are normally substantially less than what broker fees are on businesses that are listed, but that is subject to your own evaluation interpretation.
Terrific. Thanks for that. So let's talk a little bit, gentlemen, about these hidden gems. Are we talking small, mid-sized, large companies? Typically, what would a corporate executive escapee expect to be talking to you about in terms of a size of business?
Hey, Tony, it's Barton. So, Austin talked about earlier, the income level that our clients are looking for, and it's 300,000 to 2 million, that covers a wide spectrum of size of business. So the Hidden Gem program, and if you visit our website, we've got a section dedicated to it. These are businesses, these are kind of those off-market opportunities we're talking about. It's owners that we've spoken to in the last, it could have been a month ago, it could have been a year ago, but we keep in regular contact with these individuals. When we find the right pairing for them, then we reapproach them. But we have all different sizes. We've got businesses in that that are typically, we look at, a $2.5 million size of business purchase price. And that'll carry up to, I'm working with one right now that is probably about a $28 million purchase. So we have a wide variety, wide spectrum of sizes of businesses. Like I said, these are owners that want to sell. They don't want to be publicly listed. So when we have the right client, we bring them to them. The first thing that we do in our search processes after, we've done the initial engagement, we've signed up, we've built your profile. We look at that target geography that our clients are targeting. We go through our Hidden Gem marketplace, do a kind of a backtrack through those accounts that we know exist in that territory and see, is there a good fit? Obviously, we've already built a rapport and a relationship there. We've got, a varying level of financial details on some of these companies. So we're further down the road with them. So that's the first place we start when we start a new engagement.
Mm-hmm. Now, you mentioned geography, Barton. What about Canada? Is that someplace you ever search as part of your quest for Hidden Gem?
We do not. We stick to the lower 48.
Okay, got it. All right. A word or two, please, more about the profile of the typical corporate escapee. And of course, on the heels and in the midst even of this pandemic, I'm just curious, as our audience is, what about the composite, if you will, of the typical lately corporate executive that you work with in terms of their career level, their stage, their age? I think a lot of us are really asking the question, do people like me do things like this? So I'm just curious what you've seen and whether that composite has changed over the last couple of years.
Hey, Tony, this is Austin. That's a great question too. Like I said, our typical client is someone in their 40s or 50s. I've worked with clients as young as 35, clients as old as 60. The typical qualities that we find in one of our clients, especially one of our successful clients, is it's someone who has at least 10 years of executive experience, translatable experience, something that they can bring to a business. It's someone who genuinely wants to own a business. We understand that buying an existing business is an option that people consider, but it's an option that comes with its own hurdles, just like starting a business comes with its own hurdles. And the people who are most dedicated to the idea of being their own boss, those are the people who are typically the most successful versus someone who is just kind of, seeing whether or not they may come across some business that's especially attractive. The income level that most of our clients are looking for, that $300,000 to $2 million range, that's a pretty wide range. I'd say on average, our clients are looking for, and by average, maybe more than 50% are looking for somewhere between $250,000 and maybe $700,000 in personal income out of a business. So what that means is, once you buy a business, there's debt service on it. So if the owner was taking out, say, $500,000 before they sold the business to you, you're not going to be able to take out $500,000. Maybe you can take $300,000, $350,000, depending on how the financing's structured. Mm-hmm. So if our clients are looking for 250 to 500, then we're looking for a business that's currently making somewhere between 400 and 900. So someone with about that level of experience, looking for about that amount of income, that's our typical client. But if you have enough money to engage in this process, and if you're serious about finding a business and becoming your own boss, then you'd make a good client.
Mhm. So clearly having the mindset, having the financial commitment. What else, gentlemen, makes for a successful acquisition search? What are the other components that, in your experiences, you've looked at so many executives you've helped move into that space? What has been the rest of that story that's made it a successful one?
Tony, that I think that it's perseverance, as we've alluded to before. It's getting engaged in the process. Most of our clients they're maybe still working, or they've got an exit timeline, or they've been given that proverbial your group is being sold, and you're going to have to transfer to some unwanted place. We've had clients that, because of health with family, have wanted to relocate to another location. And so we help them find a job in that new geography that fit their family situation. But the typical person coming in is, maybe they're just unhappy with their career. I'm expecting a lot of people that are just listening to this webinar, they have had frustrations, and there's not going to be a place you don't have them, but they start to get engaged. They look at it. They can see themselves. They can picture themselves running some of the businesses that we introduce them to. They recognize that their skill sets are applicable across a broad range of industries, and that there can be a lot of fun. And a lot of times it's people that they truly want a better quality of life. They want to live and work in the community where they reside, where some of their professional relationships are also become personal relationships, where they can have engagement in community affairs and things like that. And so the businesses of the size that Austin are talking to fit themselves well within that. But it really is, our biggest competition, the primary reason someone doesn't buy a business when they work with us, if they've just decided to take a corporate job. They're nervous about financing, they're nervous about the loan, and that's probably the right decision for them.
Tony, this is Martin. Real quick, just to add to what Pat said.
Please, yes.
I think a couple of the things that make for a successful search from one of our clients or candidate is coming in with a realistic expectation of what this process is going to deliver to you, coming in with a realistic expectation of what you have financially to put up. I have certainly, I think all three of us can sit here in our remote principals as well and say, we've onboarded clients who, we have a process where you fill out a workbook for us. We're going to get a personal financial summary. So we know the financial background of our clients and what they have to put up, because as we said, we handle financing. So we need to know what we're walking into, what we can and can't, what's reasonably accomplishable. But for them to come in with it and say, I have X in a 401k, I've got Y in a money market, I'm willing to designate this percentage of it, and I know that my personal income needs are Z over here. I have my mortgage, I have car payments. This is what I need to operate my household from my income standpoint. Number two, spousal support. I will say that I've had a client in the past who enlisted my services without the approval of his wife. And once she brought up this process, the anger kind of made him have to put this on the back burner and walk away from the process. So this needs to be something that the household supports, that the spouse supports. This needs to be everybody on board, because we are talking about a significant investment, and it's not just another job, right? This is a life-changing event.
Absolutely. I'm going to continue with a few more questions, but everyone, you can hear it in their voices, both their understanding of this space as well as their passion for it. So I'm just going to urge you one more time, follow that link, even if you're just curious, wanting to learn more, something occurs to you. You just heard Barton share a story of how it is to move through it and not inform your significant other. So you might have something on your mind that you might just want to run by them as you make your informed decision about whether you move forward and pursue this as a corporate lifestyle for you. I'm sorry, career lifestyle for you. So back to the questions. We talked a little bit about risk here. And I think many people who say aren't so great or familiar with sales and marketing might look at this and say, well, I lack the experience and expertise to really drive my business forward. Is that a myth or is that reality?
No.
Pat, Barton, Austin, what do you say?
Yep, this is Barton. So everyone's going to come in with their own skill set. And, we talked about, you not having to buy a business in the space in which your background is. So a lot of our clients want to get out of what they were doing. They look at themselves, and I'll say, Tony, that's the number one skill set that people will tell me, at least. I've never sold anything. I've never been a salesperson. Well, that's just not true, because you are representing the organizations that you worked for. You are representing the services or the products that you're providing. So in a sense, you've always been selling. You just haven't had that designation. And maybe you haven't been, in the typical, outside salesperson or an inside salesperson. And so that's not a role or a hat that you think you've worn, but to some degree you have. So Austin mentioned this in his initial part, is you don't have that experience. Well, it may be important then for us to categorize your search in the onset as something that does it have a sales manager or at least a salesperson, or is it using, a broker network for new clients and new contracts? It's understanding how that business is driving revenue. We need to look at what are the relationships in place? Are there contracts in place that guarantees you reoccurring revenue? Or are you buying that? Is that a feature of a business that's important to you? Same thing goes with, outside of sales and marketing. It could be accounting. It's you don't have a strong background in finance. Well, there's plenty of services outside of an organization. You can hire for bookkeeping, AP, AR, tax preparation, all of that. And businesses often use those because those are skill sets that the owner doesn't possess, doesn't want to hire someone full-time because maybe it's not necessarily a full-time role and responsibility. So in those cases, that service can be retained. They already know the business. That's what most of our clients do. So it really is at that onset, in the onboarding process, being honest with yourself, saying, here's my strengths, here's my weaknesses, here's what I'm terrified to do. Okay, great. Because from that, we can now build that profile of these are some of the skill sets that need to probably exist in the business in order to make sure, one, you're comfortable with it, two, you're successful.
Mm-hmm. I'm going to ask you to field one more question, and then I think we'll start to wrap. And I'd love for you to take a few minutes at the end just to share some final thoughts, gentlemen. So final official question is, we talked a little bit about risk. I think part of what many of us who look at a new opportunity worry about is what we don't know. We don't always feel we know all the facts. I think you touched earlier on the power of the discovery process. If you would elaborate a bit more on that and just give us a view of, I wish more people ask these questions during the process. What are those things that we should be thinking of as we, for example, engage with the current owner and are really working through the transition? What would you love for your new owner to be asking early on?
Sure. So this is Austin again. Let me walk you through how the discovery process works. So if you're working with an intermediary, it's the intermediary's job after they've spoken with the owner, you have spoken with the owner, you've decided that this is something you want to pursue. It's the intermediary's job to get P&Ls, balance sheets, and tax returns for the last couple of years. Usually we're looking at the last 3 to 4 years. If you're working with an experienced intermediary, they're going to be looking through the P&Ls, through the tax returns for any notable changes in expenses or income over the years. Basically, we're doing a high overview, forensic accounting of why has the business performed the way that it has? What does the P&L tell us about the story of this business over the last few years? If you decide this is an attractive business, I want to move forward with them, you sign a LOI, then you get a CPA in for a true forensic accounting. So the level of detail that a qualified CPA is going to dive into is as deep as looking at the general ledger for the business. Every penny the business says that they took in or took out, they spent or was deposited into one of their, business accounts. Every single one of those over the last score of years is going to be confirmed. You're going to request all of the financial information, all the contractual information. And of course, it's the business's responsibility to provide that to you. But I don't think, and I'm looking over Pat and Barton's faces here, that we've ever gotten deep into due diligence and uncovered something that, that hadn't been anticipated before. Usually once you get into due diligence, you have a pretty good overview of what's coming up, but LOIs are always structured, at least the way we write ours, as no penalty for a walkaway, which means, if you get deep into due diligence and something concerns you, for whatever reason, regardless of whether or not the seller thinks it's concerning, you're free to walk away penalty free. I mean, you're not committed to buy this business until you've bought the business. It's, all non-binding. So any information that the business has produced, your CPA can and probably will request. You'll be reviewing that alongside them. You need to find a CPA that you have good rapport with. Having good rapport with your intermediary is important. Having good rapport with your CPA and your attorney is important too. So, it's very difficult for a business to successfully withhold information from you. You've got just a purview to request everything, and it's standard procedure to request just about everything. That's one of the real upsides of buying an existing business. Like I said, you're not going to buy a lemon. How do you know whether it's a lemon? Show me everything about this business. I'm going to review all of it with qualified professionals, and we're going to look for anything concerning. If there's nothing concerning there, the business is, exactly what it appears to be on paper. And if there is something concerning, just walk away.
Terrific. Okay, let's start to wrap this up. Austin, Pat, Barton, thank you so much for making time, for sharing your insight. We covered so much territory. I can't thank you enough for doing that. And thank you all for tuning in, for your attention, as well as for your marvelous questions. I hope that we're able to answer all of them. And if anything occurs to you, by all means, follow the link. If this sounds like something you could do and really want to, follow up, ask your questions, and see where it leads you. It could be someplace really, really exciting. Any final thoughts, gentlemen, before we officially wrap up today's session of Masterclass?
No, we thank you for the attention of everyone that's hung in here with it, and those that will listen to it subsequently. As we said, no obligation to talk with us. We're non-exclusive in what we're doing. And it's really important to us. We are an advisor and a mediator in this process. We want to get you engaged as soon as we find something that is of some interest to you with that owner, so that you build a personal rapport, you get the comfort level of trust, and you get that firsthand feeling of what that person does, what his staff does, what the people do, and what their market is. So thank you, Tony. Thank you, Kimberly, for your time, and we appreciate everybody attending.
Thank you all.
You're very welcome, and thank you all. And I look forward to seeing the next session of ExecuNet Masterclass. Bye for now.